Welcome to Casa Academy, Chapter 16, Part 3, where we will cover real estate appraisal. Today, we are stepping directly into the shoes of a real estate investor. You know, when evaluating an income-producing property, you'll quickly realize that different investors might look at the exact same building and arrive at completely different opinions of its value. Why is that? Well, it's because every single investor brings their own unique financial goals, their own risk tolerance, and their own return expectations to the table. So today, we're going to learn exactly how they crunch those numbers.
Here's our roadmap for today's lesson. We'll be looking at the income approach, the direct capitalization technique, the IRV formula, gross multiplier techniques, and finally, a summary with your exam takeaways. Okay, let's dive right into Section 1, the income approach, and how we actually value investment properties. What's really fascinating here is the complete shift in perspective you have to make. The income approach is designed specifically for investment properties. So rather than focusing on the physical traits of the property, like, gorgeous landscaping or the exact square footage of the living room, this approach focuses entirely on the income that property is expected to generate and the return the investor hopes to earn. At its core, the concept is beautifully simple. Investors buy income-producing properties because they expect a financial return. If a property simply cannot generate an acceptable return, that investor will just pack up their capital and invest elsewhere. Because of that, a property's value is intrinsically tied to its income-producing potential.
Now, within this income approach, appraisers rely on two primary techniques. Think of these like a branching tree for our lesson. We have the direct capitalization technique on one side and the gross multiplier technique on the other. To truly master real estate appraisal for your exam, you absolutely need to understand how both of these branches operate independently. So let's start with that first branch.
Moving to Section 2, the direct capitalization technique, where we turn future income into present value.
Direct capitalization is essentially a process that takes projected future income and converts it into a present value estimate. In plain English, it tells an investor what a property is worth today based on the cash it's going to spit out tomorrow. But to do that, the very first step an appraiser must take is estimating the property's net operating income, or NOI. NOI is simply the income remaining after you account for all expected vacancy losses, collection losses, operating expenses, and, this is key, reserves for future expenses. You always have to plan ahead for big-ticket items like a roof replacement, new carpets, or a completely new HVAC system. To actually calculate that NOI, appraisers use what's commonly called the stack formula. It's super logical. Step 1, you start at the top with your maximum expected income. Step 2, you subtract the money you won't actually collect, so your vacancy and collection losses. And Step 3, you subtract your operating expenses and those reserves we just talked about. This stack formula is covered extensively in your course materials, and you must be completely comfortable determining the NOI when these components are handed to you on the exam.
Okay, so what happens after you calculate the NOI? Once you have that number, you're missing one final crucial ingredient: the investor's expected rate of return. In the appraisal world, we call this the capitalization rate, or just the cap rate for short. The cap rate is literally the bridge between the income the property generates and the final value the investor places on it.
Which brings us nicely to Section 3, the IRV formula and calculating value.
Meet your new best friend, the famous IRV formula. It states that income equals the rate multiplied by the value. But here's the thing. As an appraiser or an investor, you usually already know the income because you just calculated the NOI, right? And you already know your required rate. What you're really trying to find is the value. So by simply rearranging the math, value equals income divided by the rate. For exam purposes, you need to instantly recognize that you solve for value by taking that income and dividing it by the capitalization rate.
To put this into a real-world perspective, imagine you're sitting at your desk reviewing investment analysis file number 741509. The file hands you the property's NOI and the investor's required cap rate, and your boss asks you to estimate the property's value. You just pull out the IRV formula, take the NOI, divide it by the cap rate, and boom, you instantly have your present value estimate. It really is that direct.
Let's move on to Section 4, gross multiplier techniques, finding value using comparables.
We are now transitioning to the second branch of our income approach tree. And as we make that shift, please note that your verification code is 162332. Now, unlike direct capitalization, which is highly mathematical and relies on projected income and strict rates of return, the gross multiplier technique looks outward. It estimates value using comparable income-producing properties that have recently sold in the marketplace. You're essentially asking, what are real investors currently paying in the real world for income streams similar to mine?
There are two common flavors of this technique that you need to know. First up, we have the Gross Rent Multiplier, or GRM, which focuses strictly on monthly rental income. Second, we have the Gross Income Multiplier, or GIM, which steps back and focuses on annual gross income. Keeping straight which time period goes with which acronym is absolutely vital here.
All right, let's tackle the GRM first. The gross rent multiplier is your go-to when dealing specifically with monthly rental income. To calculate a GRM, you take a comparable property's recent sales price and divide it by its gross monthly rent. That gives you a multiplier number. You then take that multiplier and apply it to your subject property's monthly rent to estimate its overall value. It's a fantastic, simplified valuation method that's based on actual market performance.
Now here is a massive, incredibly common exam trap, and it revolves around the number 12. Remember, GRM uses monthly rent. If a test question tries to trick you by giving you the annual rent for a GRM problem, you must divide that annual number by 12 first to get the monthly rental amount before you apply the formula. Please do not let them catch you on that.
On the flip side, we have the gross income multiplier, or GIM. This works in a very similar way to the GRM, but instead of monthly rent, it relies exclusively on annual gross income. To calculate a GIM, you divide the comparable property sales price by its annual gross income. Then you apply that resulting multiplier to your subject property's annual income. Both of these multiplier techniques, whether you're using GRM or GIM, give you a really solid, simplified estimate of value based directly on how similar properties are behaving in the live marketplace.
And that brings us to Section 5, Summary and Exam Takeaways, our final review.
Let's lock this in. The huge takeaway to remember is that the income approach is always used to value income-producing properties from an investor's perspective. It's all about the financial return, not the paint color. Within that approach, you have two primary tools. Direct Capitalization converts projected future income into present value by using the stack formula to find your net operating income and then applying the IRV formula. Alternatively, the Gross Multiplier Technique uses comparable properties utilizing either the GRM for monthly rental income or the GIM for annual gross income.
At the end of the day, whether you're using direct capitalization or a gross multiplier, your ultimate goal is exactly the same: to estimate value based on the financial benefits a property can provide. So I want to leave you with this final thought to ponder. If you were an investor today, putting your own hard-earned money on the line for a multi-million-dollar property, which of these two valuation techniques would you trust more to project your true financial return? Would you rely on the strict math-driven projections of direct capitalization or the real-world, comparable-based multipliers? Think about that as you continue your studies. Thanks for joining me on this explainer, and happy learning!